Hi, we are going to be talking about Chapter 15. Today is Class 40A for Monday, Wednesday, Friday folks, and 27A for Tuesday, Thursday folks. Now this is the financial statement analysis chapter, and we've been doing a little bit of this at the end of every chapter. So you may recall we've done things like inventory turnover, return on investments, and we started learning all these little ways to think about financial statements. And this chapter sort of combines all that information into one chapter. So we're going to talk about a lot of different financial ratios. Ratios you already learned at the end of each chapter, just a way to put them all together and think about your financial statements. Alright, how are financial statements used to analyze a business? So we've learned how to prepare financial statements, and what we're going to do now is learn, well, what do we do with those? Well, we use them to analyze the business and see how well it's doing. Investors and creditors cannot evaluate a company by examining only 1 year's data. That's why most financial statements cover at least 2 years. In fact, most financial analysis cover trends over 3 to 5 years. This chapter shows you how to use some of the analytical tools for charting a company's progress through time. These tools can be used by small business owners to measure performance, by financial analysts to analyze stock investments, by auditors to obtain an overall sense of a company's financial health, by creditors to determine credit risk, or by any other person wanting to compare financial data in relevant terms. To determine the financial performance of a company, we compare its performance in the following ways: from year to year, with a competing company, with the same industry as a whole. So this gives us an idea of what we're doing. We're taking the financial statements that we've learned how to prepare in this class, and we take that information from the income statement, the balance sheet, the statement of retained earnings, the cash flow statement, and we compare it to something. Sometimes it's just other years for the company, right? Are they doing better this year than last year? Sometimes it's another company or the industry. Compared to all the other oil companies, how's this oil company doing, right? So we compare certain aspects of these financial statements to other parts. So they relate to other companies or other years. So we compare one set of financial statements to something else. We relate them. It's relative. All right. So there are three main ways to analyze financial statements. Horizontal analysis provides year-to-year comparison of a company's performance in different periods. Vertical analysis provides a way to compare different companies. And ratio analysis can be used to provide information about a company's performance. All right? So think about that. We're going to compare. Horizontal analysis, compare across years. That's why we call it horizontal. We compare like revenue to revenue to revenue to revenue. It's like horizontal. Vertical analysis compares different companies. So I'm going to, in this chapter, we'll learn what we call vertical analysis, and we'll change our financial statements into common size, so I can compare even a very large company like Walmart that's a retailer to a very small company like Tiffany that's also a retailer, and see how their numbers compare to one another. Or ratio analysis, so I can tell how they're performing relative to other companies, relative to other years. I can use those ratios to compare two things like income or sales to inventory or assets. So it lets me compare things using a ratio. So the financial reports, that's what we're using. Before we discuss the different tools available for financial statement analysis, let's review corporate financial reports. Publicly traded companies are required by the Securities and Exchange Commission to file annual and quarterly reports, also called Form 10-K and Form 10-Q. An annual report provides information about a company's financial condition. Another part of the annual report is the management's discussion and analysis of financial conditions and results of operation, MD&A, Management Discussion and Analysis. This section of the annual report is intended to help investors understand the results of operations and the financial condition of the company. A report of the independent registered public accounting firm, often referred to as the auditor's report, is included in the annual report. So they report out their financial statements on the 10K, management does some discussion, MD&A, then the auditors report on those financial statements in the management's discussion. The annual report contains 4 basic financial statements, and you have learned them: the balance sheet, income statement, statement of equity, and statement of cash flows. Immediately following the financial statements are the notes to the financial statements. These notes include a summary of significant accounting policies and explanations of specific items on financial statements. So, we're going to analyze the financial statements, and they're available to anyone out there. The 10Ks, the 10Qs, they're all reported to the SEC, so anybody can look at them. All right. How do we use horizontal analysis to analyze a business? So remember, horizontal, that's just like it sounds, going across. Only what they're going to cross is years. Many decisions hinge on whether numbers like sales, expenses, and net income, for example, are increasing or decreasing. For example, have sales and other revenues risen from last year, and by how much? Sales may have increased, but considered in isolation, this fact is not very helpful. The percentage change in sales over time is more relevant and therefore more helpful. It is often more relevant to know the percentage increase than the dollar increase. Horizontal analysis is the study of percentage changes in comparative financial statements. Horizontal analysis equals dollar amount of change divided by base period amount times 100. So we're computing the change from year to year. Computing a percentage change in comparative statements requires 2 steps. Compute the dollar amount of the change from the earlier period to the latter. Divide the dollar amount of change by the earlier period amount. We call the earlier period the base period. So you need 2 years. You figure out the difference and divide it by that first year, and it gives you a percentage change. So here's an example. Assume Smart Touch Learning has net sales of $858,000 in 2018 and $803,000 in 2017. Prepare the horizontal analysis. So this is just of sales, right? You can do this for every single account if you want. You do it then for sales and sales returns and allowances and sales discounts and cost of goods sold and gross profit. You can do it for all of them. In this case, we're doing just sales. So you take the dollar amount of change and then you divide it by the base amount. So, step 1, compute the change. So, later period minus earlier period. So, 2018 minus 2017, 858 minus 803. So the change is $55,000. Divide the dollar amount by the base period amount and multiply by 100. This computes the percentage change, right? So you take that 55,000, divide it by the 803,000, so that tells you that you get the answer of 0.068. Then you multiply that by 100 and you get 6.8. So that means that from 2017 to 2018, sales increased 6.8%. Alright, and here's an example, horizontal analysis of the income statement. So this example, 15-1 from your book, you can see they've gone ahead and done this horizontal analysis for every account on the income statement. So net sales, right, increased 6.8%. Cost of goods sold increased 0.8%. So that's good. Your gross profit's going up by 17.3%. Right? So things are going up and down. Administrative, selling expensive and administrative expenses decreased. You know, they're doing well. Net income, it increased 84.6. If you take it all the way down to the bottom, you can see the change. So the horizontal analysis of Smart Touch Learning's income statement is shown in Exhibit 15.1. This comparative income statement reveals a significant amount of growth during 2018. Although gross profit increased only 17.3%, Smart Touch Learning was able to trim its expenses and create an 84.6% growth in net income. The two items on SmartTouch Learning's income statement with the slowest growth rates are cost of goods sold and administrative expenses. Cost of goods sold increased by only 0.8%, so less than 1%. And administrative decreased by 4.1%. On the bottom line, net income grew by an incredible 84.6%. That's real progress. So when your net income grows by that much, that's awesome. Horizontal analysis of the balance sheet. So we can do this for any accounts that are going to change, right? So you can look at your assets. So here's an example for current assets. Cash and cash equivalents decreased 9.4%. Accounts receivable increased 34%. Right? And on until you see that your total assets increased 22.2%. So horizontal analysis of the balance sheet works the same way. Compare 2 years, take the difference, divide it by the first year, you get your percentage increase. And it's just a way of thinking about how am I growing a lot or a little? SmartTouch liabilities also grew. Total liabilities increased by 33%, right? 33%. And this is another indicator of positive growth for SmartTouch Learning. Liabilities actually decreased. Accrued liabilities actually decreased, as indicated by the liability figure in parentheses. So you see accrued liabilities 12.9. So you can do horizontal analysis for any accounts that you have 2 or 3 or 4 years worth of. Sometimes you'll see multiple years worth, and then you'll see increased percentage for each set of years. So that way you can tell if it's continuing to grow or if that slacks off. So even 2 years isn't that much of an analysis. And in real life you might want 5 or so. All right. Trend analysis. Trend analysis is a form of horizontal analysis. Trend percentages indicate the direction a business is taking. The formula for trend analysis is as follows. Trend percentage equals any period amount divided by the base period amount times 100. What trend? So for example, we have sales change over 5 years. Trend analysis is a special form of horizontal analysis. Trend percentages indicate the direction a business is taking. For example, how have sales changed over a 5-year period? What trend does net income show? Trend analysis percentages are computed by selecting a base period. The base period amounts are set to equal 100%. The amounts for each subsequent year are expressed as a percentage of the base amount. So compute trend percentages, we divide each item for the following years by the base period and multiply. Identify a base period, state all subsequent amounts as a percentage of the base period amount. So let's look at an example here. All right, so we're starting with 2014, which were 750, rose to 858 in 2018. The base year is 2014, so that year's percentage is set to 100%. All right, so if you look at each year, so we're starting with 2014 out here, 750,000 is 100%. In 2015, we only did 748,000, which is 99.7% of the base year. In 2016, we did 104% of the base year. So it's not relative to 2015, it's relative to 2014. And in 2017, 107, 2018, 114. So we kind of got a growth trend going here. All right. Horizontal analysis allows a company to see the percentage change from one year to the next. Trend analysis shows the percentage change from a base year forward to determine whether the trend in net sales, for example, is positive or negative over a longer period of time. So you just look to see, is that number higher than 100% or lower than 100%? Pretty clear idea of it. Is it going up or is it going down? All right, so come back for the second part of Class 40 for Monday, Wednesday, Friday, or Class 27. All right.